Hey, what's up, everybody? It is Thursday, June 2nd. We had a nice rally in the market today. Actually opened lower, but again, we saw that buying come in. As per my recommendation or my advice to you yesterday was, you got to buy the dips. I have noticed what appears to be maybe the beginning of a shift in sentiment to a less bearish outlook, at least on the part of individual investors. The weekly AAII sentiment survey, which comes out every Wednesday, saw a very substantial drop in bearish sentiment. Actually, it was the biggest one-week decline percentage-wise ever. And data goes back to 1984. I went all the way back and checked it out. It was a 16.4 percentage point drop from the prior week. So we went from 54 down to 38, 37, something like that. It was a big drop. Bullish sentiment increased and neutral sentiment increased. So it looks like maybe some of the bears moved into the neutral camp, maybe some of them moved into the bullish camp. Why is this important? Because basically the survey has been negative for the last 27 weeks, so a little bit over 6 months. And I think some of that negativity or a lot of that negativity was a factor in the market not generating any momentum on the upside. Like interesting, because I spoke about this yesterday. Yesterday I said the data June 1st was, and we got the numbers today, but yesterday was June 1st, and I said that the first of every month, as long as it occurs on a business day, is a big fiscal flow day. I mean, it's normally like about 100 billion when you factor in you have Medicare, Medicaid, military pay, veterans benefits, disability, all that stuff that gets paid once a month that goes out on the 1st. So you get this big fiscal flow, this big liquidity, bank deposits just flush with cash. And I said yesterday, because we were down yesterday, I said that was, what wasn't such a encouraging sign when you had, and actually the number yesterday, the net amount was 95 billion. I think it was like 102 billion in actual spending, and then there was when you subtract the taxes taken out, it came to 95 billion and just almost 100 billion yesterday, and the market was down. So I said that was it was not such an encouraging sign, because when you have this huge liquidity injection, transfers to bank deposits big time, you would expect to see some of that in the market. Maybe some of it went into the market as buying puts or going short, I don't know, but that was kind of a sign of I think you could take that kind of as a sign of people are just afraid to buy this market. But it does look in some of these surveys and in the put-call ratio starting to turn back down right now, and the AAII sentiment getting a little bit more positive, or I should say a little bit less bearish. It's building some, I think it's building some psychological support to sustain the rally. Now, I was bullish regardless, because I said now, we've been through the period of the April tax-related big liquidity drain. Everybody had to pay the taxes, sell in May and go away. Half the month of May was very negative because the government was still running a surplus all the way through May 13th. And then it started to shift, then it started to turn. And when I started to see the budget balance for May flip back into deficit, I told you guys that was the bottom. Okay, the money's starting to come back in, the swimming pool analogy. You got the pool filling back up again, and that's all good. Yesterday I talked about the reduced level of flows vis-a-vis or compared to last year. That's normal, because last year we were still in aggressive stimulus mode. But I explained to you yesterday that even if we settle at a monthly flow of 500 billion, that is still 25% greater than anything pre-pandemic. Okay, and that the Trump years, which was, you know, we had tax cuts there and everything, it's still going to be 25% higher flow than anything pre-pandemic. And if you go back even further than that, it is much higher, okay? 30-40%. So, and then I said over the period of time from 2009, the end of 2009, up until the pandemic, when the economy was basically forced to shut down, that period from 2009 up until the pandemic, we had average annual GDP growth of 2.5% with 25% less fiscal flow. So I said yesterday, when you do the math, and I've done the math, and it's you can only come up with one conclusion, and that is it's a positive environment which is seeing some subtraction from inflation. Okay, inflation, as I explained yesterday, is going to be a subtraction to GDP. We have a little bit of an offset coming from the fact that the U.S. is a net exporter of petroleum, so that's good. And so we're going to settle in around, 2%, 1.8%, maybe worst case 1.5%, and that's definitely looks terrible compared to 7.5% growth that we had in the fourth quarter of last year, but it's growth nonetheless. And growth means you're going to get higher corporate profits. It's just going to be slow, growing at a slower pace. We're getting now from most companies, and we had Microsoft today, lowering their guidance. So the market is digesting all this now, and when the actual earnings come in, the negative news will basically already have been factored in, and I think the market we got a good, I think the path is bullish, and like I said yesterday, it's not going to be one of these straight up trajectories, because we've had a significant slowdown in the fiscal, but the fiscal is still enough to sustain a growth trajectory. And as long as we're on a growth trajectory, the stock market is going to trend higher over time. You're going to have appreciating stock prices. Not to mention the fact that a lot of stocks have been beaten down so badly, particularly in the tech sector, that there's just tremendous values out there. And I've been repeating this over and over to you guys, saying like, you got to buy this stuff. You got to buy now. You got to buy the dips. You got to buy on weakness. You got to take a longer term time perspective. And that's how, if you could tweak your behavior to do exactly that, to take advantage of these times when the market is offering these discounts, you're going to do very, very well over time. No question about it. Now, a couple of things came out today related to oil. First of all, before I mention those things, I will talk a little bit about the EIA Weekly Petroleum Status Report. So I didn't see, there's no real, not a significant, I should say, decline in gasoline demand, even with prices where they are, record prices. We're down about 3% compared to last year, gasoline demand. That's not terrible. Inventories are very tight with crude, gasoline, and distillate. Actually, distillate inventories are at a 14-year low. So inventories are very tight. Exports are still really strong. We had a little bit of a pullback in crude oil exports in the latest week, but product exports were up. And net exports still, or I shouldn't say still, but they're at 1.4 million barrels a day. That was down slightly from the 2 million barrels a day the prior week. So U.S. is still a net exporter at a significant level, I should say. U.S. domestic crude production at 11.9 million barrels. I think that could be like the 5th or 6th week that we've been stuck there. but that is the highest production in 25 months, but it's still way below. You know, we were up around 13.2 million barrels just before the pandemic. What I was going to say, the new information that came out today is Biden is taking a trip to the Middle East, and it is being, they're speculating, or they're saying he could make a trip to Saudi Arabia. Obviously, that would be to cajole, encourage, convince, whatever, verb you want to use, the Saudis to pump more oil. Separately, OPEC is saying they will bring forward their planned output increases, right? Because the output increases were going to go through until September, I believe, to make up for that 3 million barrel a day cut that they did during the pandemic. They said they're going to bring forward those output increases because Russia's output is now maybe going to be impacted by the European ban on Russian oil. So some potentially bearish developments for crude prices, although I would reiterate, I'm not going short, or I would not recommend a short position in oil until I see producers flip their net position excuse me, from long futures, net long futures, to short. And again, I'll repeat, the producers, oil producers, have been net long the futures market since November of last year. And they've reduced that position, over the last several weeks, but they're still net long. And I would not take a bearish view on oil, or a bearish position on oil, until I saw that flip around. So anyway, I guess you could say all this is kind of running according to how I anticipated. The market is in an upward trend. Fiscal is back, flowing, maybe not at the same rate it was last year or over the last 2 years with the pandemic stimulus, but it's still enough, significantly enough, I would say, to keep us keep the economy out of a recession. We will be on a growth track, and as long as that's the case, then the stock market's going to trend up. It's not going to be some crazy, straight up bull ride, but if you're patient and if you buy the dips, today was a great example. I mean, when you get these days, and this has been the pattern, today it broke the pattern a little bit because it came in, came in a little bit higher. Then we had the reflexive sell-off, and then it came right back, turned positive, and turned sharply positive by the end of the day. So that's it for now, folks. That's the update, and see you tomorrow. Bye.